Hello, Steve Lentz here with Discover Options, and welcome to this edition of the Market Reports. This will be for Friday, August 26th, getting ready for Monday, August 29th. We'll cover two reports, the S&P 500 Condor Butterfly Timing Report, as well as the S&P 500 Directional Likelihood Report. Now, we would love for you to subscribe, and you can do so by clicking on the button below. Also, before we get to the reports, you should know that you can get a ebook by clicking on the link in the above right, and this is the Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Now we'll cover two different reports today. First, the Condor Butterfly Timing Report, and then we'll get to the Market Likelihood Report, both of them regarding the S&P 500. Okay, so the Condor Butterfly timing report is for advanced options traders doing range trading approaches with condors, butterflies, etc. We're going to go over the why you would look at this report, the methodology first, and then also, of course, we'll get to the current market condition and then the edge level you have as a premium seller using those strategies. Why would you want to consider looking at this report? Well, just as an example, if you were to go back to December 31st of last year, take a look. As a range trader, you may have concluded that the market was beginning to trade in a tighter range, and yet when you crunch it through the algorithms we use and have developed here at Discover Options, we discover then that there was actually a minus 4% edge, minus 4.2% edge. Now, what does that mean? All right, what this meant at the time was that there was a higher than usual likelihood that the market would be more volatile than what was being implied at the time by the option prices. Now, that's not good if you're a premium seller. From a market neutral standpoint, condors and butterflies, etc. In this case, look what happened. Of course, the market got extremely volatile, especially on the downside there. Okay, now we know we can cherry pick, examples, and that's an obvious one I wanted to show you. But nevertheless, the premise is very, very good. And this is what we do. We take a look at the market condition, all right, and we ask ourselves a question. Is this current market condition a good one for selling premium through range trading? Now, this condition, I define it by three different ways. First, we look at price action, trend, and then the overbought oversold status. So the price action that we see is that Thursday was a downswing day, and then Friday was an outside day with the high greater than Thursday's high and the low lower than Friday's low. All right, so that's kind of unusual, an outside day occurring while the trend is up and occurring while the 15-3 stochastic was between 0 and 60. This market condition has not existed very often in the past with these three definitions of price action, trend, and the overbought oversold levels. In fact, if you go back to January of 2000, it's only occurred roughly 22 times, okay, where all three of these conditions are met between price action, trend, and the overbought oversold. So it's interesting to see what happened in those 22 times when it did occur. All right, but we are first addressing the notion of range trading. Would this have been a good time to do range trading? So here's what we do. To determine this, we first are going to observe how much the market actually moves from a given close. We're describing our methodology here. We call this actual volatility. Next, we observe what the market move that was being predicted by the options prices. This was implied volatility. We then compare the implied versus what actually came about to determine if that particular bar turned out to be favorable or unfavorable. We're not going to know for another 21 days or so. Okay, but in the end, at the end of the day, we can look back, and then what we do is we like to, look back and determine if a bar was favorable or unfavorable. Here's an example of actual volatility. What we do is we take a look at a close. We then go forward in time 21 bars and take a look at how far the market moved from that close. In this case, it went down 50 points, which turns out to have been 2.4% of the index value at the time. Now, here's the question. What was being implied at the time by the option prices? What market move was the VIX saying at the time? And when you look at it, the VIX was implying a move of 4.4% at that time versus 2.4%. So here we have a situation where the option prices were implying a much higher move than what actually came to pass. And so we would paint that bar blue, meaning favorable, and then the bars are painted red where it's the opposite, where the market was implying a much lower move than what actually came about. So in this way, we go back in time and we look in hindsight and determine whether a bar was favorable or unfavorable. All right, now the 21 bars on the right leading up to Friday, those are colored black because we don't really know yet whether those bars turned out to be favorable or unfavorable. All right, so there is that. Now, what we're going to do is ask ourselves historically, what percentage of the bars going back are favorable? We're going to go back to January of 2000 and see exactly how what the percentage was of the bars and the SPX options, the SPX market turned out to be favorable. Then we look and we get a benchmark reading then. Then we look at the bars that match our current market condition. Only 22 have occurred. And then of those 22, we ask ourselves what percentage of those were favorable or unfavorable. And then we see if there's a difference between the historical benchmark and then the one with the market condition. So here we go. If you go back in time and look at all 4,200 or so trading days in the SPX going back to Jan of 2000, 64.7% of those turned out to be favorable bars for selling premium. 35.3% of those turned out to be unfavorable. Okay, now we're going to take a look at our market condition here and ask ourselves, of those 22 incidences that this market condition we have now was duplicated in the past, what percentage of those turned out to be favorable? And look at this. Only 57.1% of those turned out to be favorable. Okay, now what does that mean? That's a lower percentage than the benchmark. This means we have a negative edge. It means there is a higher than usual likelihood that the market will be more volatile than what is implied by the option prices. Now keep in mind, again, only 22 incidences where we have this outside bar occurring above the 50-day moving average coming from a downswing day, and that are in a downtrending stochastic between 0 and 60. That just doesn't happen very often. But when it does, it would appear that for range traders, there would appear to be a negative edge in that case. All right, so that's the conclusion on the Condor and Butterfly Timing Report. Doesn't look too favorable, but then again, the number of incidences isn't that robust, so that's something to keep in mind as well. Let's go to the Market Likelihood Report. Before we do, I want to make sure you understand that at Discover Options, we have a full array of mentoring programs for you, ranging from those for the beginners, introduction to options, covered calls, puts, callers, etc. We have a great little class, a series of courses for you to take regarding trading earnings announcements. Finally, we have a full-blown equity track, 14 courses, all wrapped up into a great progression of classes that will give you just a great foundation to become an advanced options trader. For those of you trading futures options, we have the futures track. Go to the website, please. Take a look at the curriculum we have, and we have professional traders who will mentor you in getting up to speed and where you really want to go. Okay, now onto the Market Likelihood Report using statistical volatility. The market condition we have right now, we've already been through, but here's the question on this report, which we'll answer. Since Jan of 2000, how often has this same condition occurred? Okay, we know that's 22 times, right? And what direction did the market go? So we're going to go back and look at those 22 incidences and ask ourselves, what did the market do? Now, to do this, we have a specific methodology to lay this out here. And this is, first, we want to understand the historical distribution of price. Then we want to understand the price distribution after our market condition has developed. Okay, and then we compare what the market did with our market condition we have, going back each of those 22 times. We compare it to the historical benchmark. And if there's a big difference, then we might conclude that there is a certain edge that might exist. So how do we determine historical distribution of price? We measure historical distribution by observing how often price touches one standard deviation volatility bands that are placed from each bar's closing price. We look at 5, 10, and 15-day bands. These are measured one standard deviation from the close using a 20-day historical volatility log normally distributed. Here's just an example of these volatility bands, and then we're going to get to the results here. All right, so take a look at this. We look at the upper band, which is set 10 days into the future, one standard deviation above the close. 10-day band set one standard deviation down below the close. Now here's the question. Did the market in this case go up and hit the upper band, go down and hit the lower band, or wobble in the middle and hit neither one? Let's take a look here. And in this case, for this close, it hit the upper band. In fact, it did it just the very next day. Then we have this close right here, and we look at the upper band up here, 10 days out. Then down here, 10 days out. And the question is, did the market over the next 10 days hit the lower band, hit the upper band, or wobble in the middle? Let's see. And we can see that it tried to go down and hit the band here, but it failed to. So in this case, it hit neither. So that's what we report for this particular close, is that it hit neither band. It hit neither band for that particular incident. Now look, here's what we do. Historical distribution is measured like this. From every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. Okay, so we're going to look at the distribution of price in 3 different time frames this way. Okay, and here's what we get when we look at the S&P 500. Okay, over the last 4,212 occurrences, that's going back to about January of 2000 or so, the SPX hit the upper 5-day band 29% of the time, the upper 10-day band 23% of the time, the upper 15-day band 23% of the time, and then on the lower side, it hit the lower band almost 30% of the time, the lower 10-day band about 30% of the time, and then the lower 15-day band 32.4% of the time. Okay, now we're going to go to our current market condition. Now look at this. If we find a particular market condition where it hit the upper bands 100% of the time, wouldn't you conclude that that market condition is probably quite bullish? Certainly. At the same time, we would expect then in that case that it would hit the lower 10-day, or the lower bands 0% of the time, if it was the ultimate bullish market condition, right? Well, alas, the world doesn't work that way. I've never run into a market condition that comes up with 100% and zeros, but we can at least run it through the system and see what we get. So here's what we get for the current one we have now. Oops. Nope. Where am I here? Okay, here we go. We're going to understand the distribution after our condition develops. Here we go. And I wanted to point out, we're going to look at it at the close, our distribution at the close. I'm going to look at the distribution after our condition here, assuming price goes above the high of Friday. Okay, and of those 22 times in the past, there's going to be times when it actually went below the low of that day, and we'll see what the distribution was at that time. So here we go. Okay, this is as of the close. Okay, so if you go back to those 22 occurrences as of the close, you'll see that it hit the upper 5-day band 36.4% of the time, which is more than the benchmark. It hit the upper 10-day band more than the benchmark. It hit the upper 15-day band more than the benchmark. Do you see that? In fact, let me see if I can grab this. I have the differences labeled out right there. Perfect. There we go. And so you can actually see then, here are the differences in blue. In fact, in all 6 of the cases of the bands, all 6 bands were hit more often than the benchmark distribution. What does that mean? Folks, this is a picture of increased market volatility. Increased market volatility. All 6 of the bands were struck more often than the benchmark, both to the upside and the downside. It's not leaning bullish or bearish. It's at the close anyway. It's definitely just simply saying more market volatility. That's what's likely here. Okay? All right, so now let's go to the next one. Let me see here. Boom, there we go. What if price goes above the high? Very interesting here. The upper bands all are struck more often. The lower bands are all struck less often by just a little bit. So this is a picture of bullishness. If on Monday, price goes above Friday's high, historically, on a very slim set of occurrences, we're seeing a picture of more likely bullish behavior. Now, what if it goes below the low of Friday? Well, this is a picture. All 6 bands were struck more often. So this is just simply an example of increased market volatility. Even the upper bands were struck more often, even if it goes below the low. So this is just a picture of increased volatility. If it goes above the high, you're looking at a slight, better chance for bullish behavior. But all in all, we're looking at more market volatility and more bullish behavior if it goes above the high. That's what the past is telling us. So, folks, what I like to do sometimes is recast these bands in a bit more of a sophisticated way. Rather than using a 20-day statistical volatility, instead I'm going to take the VIX itself, and I'm going to carve the VIX up into 2 different volatility levels. One is going to be the upper volatility, and I use the SIBO's published skew value to back into that. And then we look at a volatility for the downside. And this is reflected in the SPX options, if you think about it. The out-of-the-money puts and the SPX have a higher volatility, higher implied volatility than the out-of-the-money calls. And that's what the skew value that the SIBO publishes is reflecting. All right, and that's what the market is predicting in terms of future behavior. So let's go and look at these bands set to the skew adjusted VIX. Now the VIX is typically much higher than the 20-day statistical, so the bands are generally wider apart, and hence they are struck less often. Roughly 15 to 21% of the time, 15 to 21% rather than say 23 to 32%. Under statistical. So they're wider, they're farther out, they're getting struck less often, but these are reflecting what the VIX is predicting, what the market itself is predicting, not what the 20-day statistical is predicting. All right, so now what do we get? So as of the close, we can see 5 of the 6 bands are getting struck more often. All right, if price goes above the high, we can see similar behavior here. The upper bands getting struck more often, and 2 of the 3 lower bands get struck less often. So that's a bullish picture, as we talked about. And in the case where price goes below the low, we can see that 4 of the 6 bands are getting struck more often in that case. Okay, so kind of confirms pretty much what we saw before. Generally, we're looking at more market volatility. That's what the at least the history is telling us, that there's a greater likelihood for more general market volatility. If price goes above the high of Friday on Monday, well, then we have a chance for some definite bullish behavior continuing further. All right, now I wanted to show you here, this is the statistical we were using on the first bands. When we carve up the VIX, the upside volatility is 11.4. And then when we evaluate a trading idea for you, we're going to use the downside VIX of 15.9. 15.9. Let's go take a look at an idea here. If it goes above the high on Friday, you may consider using option view to run it through this kind of a ringer, a hedged bull put spread. We're going to take that 15.9 value, pop it in right up here after we click that S button. We're going to put a 15.9 in the SV box. And when we do that, we would then do a hedge here, a bear put spread, just a one lot, 10 points wide. We go out to the first strike beyond the first standard deviation and do a 5 lot, 20 point bull put spread. At the end of the day, this is bringing in far more money than this hedge is costing. So no matter how much the market goes up, we have a profit coming to us. But then if the market goes down, this hedge is going to make some money for us while this bull put spread is being threatened. So at least we get some payoff for incurring some headache there. And here's a picture that we can see of this. If price goes up, we're going to make money no matter what. If it goes down, the hedge kicks in, and at expiration we can actually make more than 3 times at expiration what we would get if it just went up. Now we get in trouble, of course, if it goes to that short strike and beyond. So that's our kicker to get out. That is our stop. We're going to get out if it hits that short strike there. Here's what the trade looks like in our price chart using the profit area. Okay, now we're talking about doing this only if price ascends above the high. Okay, now that's going to take quite a move on Monday to do that. Okay, if it keeps going down, I would be leery of selling premium in a bullish fashion like this if it keeps going down. We're in for some market volatility coming up here, and we want to be very careful. But if it goes above the high, the past tells us that we're in for some bullish behavior. At least there's a greater likelihood for bullish behavior after that. Okay, so this is kind of, you can see the wide green area, not too bad. All right, so I hope this has been helpful. I hope this has given you some good ideas for trading your own account. I'm Steve Lentz with Discover Options. Go to our website, check out our curriculum, and we'd love to hear from you. Take care. Have a great week trading. Bye-bye.